Hello, and welcome to Arnerich Massena's first quarter MarketCast. It's been more than 2 years since the onset of the pandemic, and despite the many economic hardships, stocks and bonds rose during the past 2 years, driven in part by monetary stimulus and government spending. But in the past few months, it looks like a reversal has begun as the flood of money and spending that fueled the recovery is now starting to be withdrawn. This reversal could lead to some leadership changes in the market in the coming months and years to come. In today's MarketCast, Senior Investment Advisor Melody Behnke and I will talk about what's driving markets and what our strategy is going forward. I'll turn it over to Melody to get started.
Thank you, Bryan. Stocks and bonds declined in the first quarter as rising inflation and rising interest rates took a bite out of valuations and growth expectations. U.S. bonds had their largest quarterly decline since 1980, and U.S. large-cap stocks had their first negative quarter in 2 years. While stocks and bonds moved lower, Treasury bills and hedge funds not only provided diversification, but also generally preserved capital. Here we can see how inflation, measured by the Consumer Price Index, has been running a lot higher than bond yields over the past year. This has caused investors to demand higher yields, which means lower market prices and lower returns for existing bonds. Despite the Fed's recent move to tighten monetary policy, inflation expectations are still very high. Based on market data, it looks like investors still expect inflation to average over 5% over the next 12 months. So, how does this inflation challenge fit into the bigger picture? Here you can see almost 100 years of stock and bond returns. The first thing to notice is that despite periods of volatility, stocks have been the best performers by a wide margin. Even bonds have outperformed inflation over the long term by a smaller amount. But if you look closely, you can see that recently this hasn't been the case. In the highlighted area, we can see that bonds have been roughly flat since mid-2019, while inflation has continued to climb. So if inflation can hurt bond returns, the question then is, can inflation hurt stock returns too? Based on history, it looks like high inflation can detract from stock returns. If we sort the annual data by levels of inflation, we can see something remarkable. During years of low or moderate inflation, stocks have on average outperformed inflation by a wide margin. However, during years when inflation was high, over 5% at year-end, stocks have on average underperformed inflation. Based on this, we think stocks could be facing headwinds this year. And it's pretty clear that high inflation has been having an impact on consumer sentiment too. Here you can see that consumer sentiment, which measures how consumers feel about their finances and the economy, has been falling lately. While we don't know when consumer sentiment will hit a bottom, we do know that historically, when consumer sentiment does hit a major bottom, stock returns over the next 12 months are often attractive. But in the meantime, as inflation remains high and consumer sentiment continues to fall, we are taking a more cautious view. Despite the difficult market environment, we think that active portfolio management can provide an edge. Here you can see that since 2000, U.S. large-cap active managers have on average outperformed the S&P 500 index in both declining markets and modestly rising markets. However, these active managers have underperformed during rapidly rising markets like we've seen in the last few years. While we expect quarterly active manager results to vary widely by style and market environment, we believe that active managers should continue to add value during declining markets over rolling 3-year periods. And now, to put all this together and discuss our tactical views, I'll hand it back to Bryan Shipley.
Thank you, Melody. Last quarter, we noted that markets were entering a more difficult period, and we downgraded our view on growth-oriented investments and strengthened our relative expectations for conservative investments, such as defensive low-duration bonds. We continue to maintain those views as we expect the Fed's battle against inflation will pose a challenge for investments in the near term. This is also why we're continuing to favor hedge and diversifying investments that can provide returns that are less correlated to traditional markets. But during this turbulent time, we are also acutely aware that markets are forward-looking and that expectations can rapidly pivot as events unfold. This means it's very important that we remain nimble. And this is why, as Melody pointed out, we often recommend active managers who can quickly identify and respond to new challenges and opportunities as they unfold. Given the market changes we discussed, it's likely some new opportunities will arise in the coming months or quarters. Your advisor will work closely with you on specific opportunities as they become available. April is Financial Literacy Month, and Arnerich Massena is proud to announce that the firm has become the first Oregon sponsor of Rock the Street Wall Street, a nonprofit organization that brings financial and investment literacy programs to high school girls. A team of Arnerich Massena volunteers led by co-CEO Regan Ray and advisor Catherine Fox will be providing instruction and mentorship to girls at Grant High School starting this fall. We are really excited to help inspire girls to careers in finance. You can read more about it on our blog at arnerichmassena.com. Thank you for joining us today.